Hello and welcome back to Explain the Charts. Today is October 20th, 2025, and we're taking an in-depth look at the New Zealand dollar versus the US dollar, NZDUSD. In this video, we'll cover the latest news driving this pair and then dive deep into the charts to identify key trends, levels, and potential trade setups. First, let's talk about the fundamental picture, which is currently dominated by central bank policy divergence. The Reserve Bank of New Zealand, or RBNZ, is signaling a clear dovish stance. Markets are overwhelmingly pricing in a 25 basis point rate cut for their next meeting in November, with some even speculating about a potential 50 basis point cut. This is happening despite New Zealand's headline inflation recently hitting 3%, the very top of the RBNZ's target band. However, reports indicate that underlying inflation measures are softening, giving the RBNZ the green light to prioritize stimulating a weaker economy. On the other side of the pair, we have the US dollar, which has been showing broad strength. This is fueled by diminishing expectations for Federal Reserve rate cuts in 2026 and hawkish commentary from officials like Kansas City Fed President Jeffrey Schmidt, who recently stated that US inflation remains too high. This stark contrast between a dovish RBNZ and a relatively hawkish Fed creates a powerful fundamental headwind for NZDUSD. Adding to the pressure are ongoing US-China trade tensions, which tend to weigh on commodity-linked currencies like the Kiwi dollar. So, the overarching narrative is bearish, with many analysts suggesting that selling rallies is the preferred strategy for now. Now, let's see how this bearish narrative translates to the daily chart. As you can see, the pair has been in a clear and sustained downtrend since peaking above 0.6350 in late September. We have a classic bearish structure of lower highs and lower lows, which confirms the long-term selling pressure. The price saw a significant breakdown in early October, falling sharply from the 0.6100 area. This established a major resistance zone around 0.5800 to 0.5850, a level that acted as support before failing. Looking at the current price, the most critical support level is down around 0.5678. We can see the price tested this exact level with long wicks on both October 7th and October 14th, finding buyers each time. This makes 0.5678 a very important line in the sand for the market. To the upside, immediate resistance sits near 0.5754, with the more significant psychological and technical barrier at 0.5800. Any bullish attempt would need to convincingly clear these levels to challenge the downtrend. Let's zoom in on the price action since mid-September to get a clearer picture of the recent moves. Here you can see the steep decline in late September and early October, followed by the bounce off that critical 0.5678 support level. Notice the candle on October 14th. It's a bullish pin bar or hammer, which often signals a potential reversal or at least a pause in the trend. However, look at the candles that followed. October 15th, 16th, and 17th are all small-bodied doji-like candles. This pattern shows a great deal of indecision in the market. The bulls were unable to produce any meaningful follow-through after the pin bar, and the bears haven't yet been able to push the price to new lows. This tells us the market is currently in a state of consolidation, coiling up after a big move. This period of indecision is crucial, as the direction it breaks will likely signal the next significant move for the pair. To analyze this consolidation in more detail, let's switch to the 1-hour chart. Here, we can see the choppy, sideways price action of the past week more clearly. The price is effectively trapped in a range, roughly between the support at 0.5710 and resistance, around 0.5750. This pattern looks very much like a bear flag or a bearish consolidation. After a sharp drop, it's common for price to move sideways as sellers take profit and new sellers enter the market. The lack of a strong bounce from the recent lows is a sign of underlying weakness. Bulls have repeatedly failed to push and hold the price above the 0.5740 to 0.5750 area. For short-term traders, this range defines the current battlefield. A breakout in either direction from this consolidation will provide the next clue for short-term direction. Finally, let's look at the 15-minute chart for an intraday perspective. As expected, the price action is very choppy, reflecting the consolidation we saw on the higher time frames. We can see minor support and resistance levels forming, for example, around 0.5720 and 0.5735. This time frame is useful for scalpers and day traders looking to trade within the established range. However, without a clear directional bias, trading in these conditions can be challenging and requires careful risk management. The key takeaway from the shorter time frames is the confirmation of indecision and the absence of strong momentum from either buyers or sellers at this moment. So, let's go back to the daily chart and summarize everything we've discussed. The long-term and short-term pictures are overwhelmingly aligned with the bearish fundamental news. The dominant trend is down. The key support level to watch is 0.5678. The key resistance levels are 0.5754 and, more importantly, 0.5800. Now for some potential scenarios. The bearish scenario, which I believe has a higher probability, around 70%, is that this current consolidation will resolve to the downside. A sustained break below 0.5678 would confirm the continuation of the downtrend. This would open the door to targets at 0.5600 and potentially lower over the coming weeks. This view would be reinforced by a rejection from the 0.5754 resistance level or strong upcoming U.S. economic data. Alternatively, the less likely bullish scenario, with about a 30% probability, would require a significant shift in sentiment. For this to happen, we would need to see a decisive break and hold above the 0.5800 resistance. This could trigger a short squeeze and a deeper correction towards the 0.5900 level. Such a move would likely need a catalyst, such as surprisingly weak U.S. data or an unexpected hawkish shift from the RBNZ. Things to watch for in the coming days are the U.S. CPI and PMI data releases, which will be crucial for the Fed's outlook, and, of course, the price's reaction to the key levels we've identified. Thank you for watching this analysis on Explain the Charts. If you found this helpful, please hit the like button, subscribe, and let me know your thoughts on NZDUSD in the comments below. And now for the disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. Trading and investing involve significant risk, and you should always conduct your own research before making any financial decisions.